Welcome to Morning Coffee, your daily fix of top stories in financial services. Today is Friday, and an electronic trading firm that pays over $1 million per head has been accused of making billions from sinister trades. Goldman Sachs, meanwhile, has significantly cut its losses. Last year, Jane Street took two of its former traders to court, accusing them of selling trade secrets to their new employer, hedge fund Millennium. The focus was a strategy in the Indian options market, which Jane Street claimed made it $150 million in 3 months alone. The case was settled before the strategy was actually revealed, but new details are now coming to light. The Securities and Exchange Board of India published an order yesterday claiming that Jane Street made $4.3 billion from 2 years of sinister trading, accusing it of manipulating the market at the expense of smaller investors. The Ken, an Indian business news website, claims that Jane Street was making big investments into the components of the Bank Nifty index fund and then selling them all at once to drive the price down. All the while they shorted the Bank Nifty index fund, and that's where the real money was made. We say was because Jane Street has now been banned from accessing the Indian market entirely. The Ken also suggests there could be wider implications for the rest of Jane Street's global operations. Jane Street paid its roughly 3,000 staff an average of $1.4 million last year, meaning the pressure will be on to create the next crazy strategy. Separately, when Goldman Sachs faced steep capital requirements last year, regulators suggested it could lose $40 billion in a severe downturn. Now, the FT reports that regulatory estimates of Goldman's losses have been cut to just $300 million. That's good news for banking bonuses. Goldman disputed the $40 billion figure initially, saying that it would cut costs, including in the form of bonus cuts. Now it seemingly doesn't have to. Meanwhile, working on a company board used to be easy, but Bloomberg is reporting that the workload has doubled and infighting has intensified. Bloomberg says that more than half of non-executive directors want to remove at least one colleague from their board. And the Wall Street Journal reports that young professionals are redefining their ideals of success. Some have stopped aspiring over 80-hour work weeks in fear of having no life outside of work.